Hello everybody, it's Tortoise Investing coming at you today with 5 more dividend stocks that you can buy and hold forever. Got some pretty great compounders for you today. 3 stocks, 2 Reits. If that excites you, you want more dividend love in your life, hit that subscribe button. It is super free to do. Hit the like button as well. Comment down below. All of that helps the channel out a bunch and makes the YouTube algorithm very happy. Well, if you are new, this is kind of what I do around here. I do buy and hold forever dividend stocks. I throw out some little tip videos, look at some ETFs, some REITs. I do a little bit of everything here. So hopefully you join the 543 that have already done so and help me march on to 1,000, 10,000, and that ultimate go of 100K. Now, without further ado, what we're going to be taking a look at today is Hershey, Genuine Parts Company, Bristol Myers Squibb, Realty Income, and Vici Properties. If you came just for the list, there you go. Appreciate it. Like and subscribe for more. And now let's take a little bit of a deep dive. Hershey, I opened a position recently in it. Before I go and just start spouting out numbers, none of this is financial advice. I'm not telling you to go out there and buy these and get guaranteed returns. All this for entertainment and educational purposes only. Now, without further ado, Hershey, $223 currently. It's got just free cash flow yield of $346. Has a dividend yield of 2.13% and a payout ratio just a little bit over 50%. I really like Hershey. I love the moat that's behind this company. And it was off its recent highs of around $275, and it's kind of coming back down. And I am DCAing personally into this. Every 2 weeks whenever I get paid, if it stays below 230, I'm buying. That's just what I'm personally doing. I love this company for the long term. Revenue's been increasing at a rate of 6.75% over the last 5 years. It is accelerating, which is what you like to see. The free cash flow has been increasing at a rate of 12.76% over the last 5 years. Up and to the right, another thing that's what you like to see is check the adjusted free cash flow. Stock-based compensation is not an issue. EPS is growing at a rate of 16.69% over the last 5 years. Growing EPS, a growing company. And their debt, they are paying down their debt. At one point was $3.79 billion, now down to $3.02 billion. Their $3.02 billion debt, their EBITDA is 2.06, which is perfectly fine. I don't like companies that hold more than 3 times their EBITDA in debt. So if this was, $7 billion, that'd be a little bit of a red flag for me. But it's not completely manageable. That just means that if they wanted to, they could pay this off very quickly. The dividend's been increasing at a rate of 12.69% over the last 5 years. Just a stair step up and to the right. You love to see that. Shares outstanding, they're buying them back slowly. Nothing really to talk too much about here. There's not a whole lot going on, not even 1% a year. The return on capital employed, now this is what I want to look at. I love a growing ROC. 2020, as all things did, they had a dip in their ROC, but it is ticking right back up. I like to see that, and I like to see ROCs above 15. And 2020, when the things were worse, it dipped to 19, and now it's above 20 again. So a lot of green check marks for me. Let's take a look here. They've been increasing their dividend for the last 14 years, so pretty decent. Next up, General Parts Company. Another company that I really like. This one's very just stable. That's how I would describe this. You take a look at the 1 year chart with all the chaos or things that are down like 30, 40, 50% right now. And this is just kind of withering the storm. There's no really big ups and downs. It's a good recessionary play in my eyes. If you're looking for a stable stock, it might be something you want to look into. Now, the adjusted free cash flow yield is 3.08%. The dividend yield is 2.41%. And the payout ratio is a little bit over 43%. No issues there whatsoever. Take a look at the revenue. Revenue's been increasing at a rate of 6.26% over the last 5 years. Over the last 2 years, look at that. It's accelerating. I like to see that. 15.59%. Very nice. The free cash flow over the last 5 years, 11.36%. kind of up and to the right-ish. It's slowly growing. This company's been around for a while, though. It's been around for a long time. EPS been growing at a rate of 14.73% over the last 5 years. Very nice. You're going to ignore this because it's going to be taking it off of this. Again, the 2020 dip that everybody had. So, yeah, the average over the last 10 years, 7.22%. Not too bad. They do have a little bit of debt, $3.08 billion. EBITDA is $1.99 billion. Almost the same situation with Hershey. No issues there in my eyes. And the dividend's been increasing at a rate of 5.87% over the last 10 years. Again, just very nice up and to the left, up and to the right. The thing, I just want to show you this with this company. Been increased their dividend for 68 years. That's probably a lot longer than most of yous have been alive. So they know what they're doing. They've got their stuff figured out so they can keep that dividend growing. Shares outstanding been decreasing at a rate of right at a 1% over the last 10 years. And it looks like they are doing share buybacks a little bit more, 1.32% over the last 1 year. And the return on capital employed was around 13.3, 13.65, 16.25, 18.69, growing. And it's above 15 now. I like it. Big check mark for me there. Next up, Bristol Myers Squibb Company. This one is one that is beat down. This one had a recent high of 74 down to 61. Let's take a look at the 1 year chart here. Thing cracked over 80 at one point. So it's down almost $20 off of its high less than a year ago. Let's take a look at it, though. Got adjusted free cash flow yield of 7.98%, payout ratio of 3.72%, and a payout yield of 3.72%, a payout ratio of 65.6%. A little bit on the high side, but you don't, it's not in the 70s or anything, so not that bad. Revenue has been increasing at a rate of 17.31% over the last 5 years. A nice, good little hefty jump right there. Free cash flow has been increased at a rate of 23.14% over the last 5 years. It looks like they have got things in order and figured out. The EPS been increasing at a rate of, we're going to look at the 10 year, 9.78% over the last 10 years. Just a nice little up and to the right. Again, everything had the 2020 hiccup. Their debt, they've been paying down their debt rapidly. In 2020, they had $48.17 billion in debt. Now they're down to $34.92 billion in debt. So that's a good little chunk of that took away. Their EBITDA is $19.92 billion, $34.92 billion. Not an issue there in my eyes. I like that. That is still within the 3 range. And the dividend's been increasing slowly but steadily at a rate of 5% over the last 10 years, 7.34% over the last 5. So, not too bad. Return on capital a bit lower than what I usually like. 13.78% as of last year. But the big thing with this one, the reason I want to point this out, it is down. Yes, it is down hard off of its high of $81. They are increasing their buyback program by $4 billion. They're going to be buying back shares like crazy. As share count's going to be dropping. And as long as, the price is low, that's when I want a company buying back shares. I don't want them buying back shares up here. They're going to announce an accelerated buyback program. I want them to announce it down here, or even drop a little bit more, because you want your company to buy back cheap shares. You want your company to use the money, the allocation that they have towards something that's going to benefit you as a shareholder, and that's either by paying a dividend or doing share buybacks. And they're doing a little bit of both. They're paying a pretty nice little dividend, 3.72%, which is sustainable at 65%. And they announced the buyback program. So that's the big thing I wanted to point out here of Bristol Myers Squibb. I love buybacks. I am a sucker for some buybacks. They've been increasing their dividend over the last 16 years. So, again, pretty nice. Next up, the Reits, Realty Income Corporation. If you are a dividend investor, you more than likely have heard of this company. This is known as the monthly paying dividend company. They've been increasing their dividend for a while, and they've been paying it every month for a while. Now their adjusted free cash flow is at 6.81%. The dividend yield is at 5.23%. The revenue is just nuts, 21.54% over the last 10 years. Free cash flow on hand, 22.89% over the last 10 years. Just up and to the right, aggressively up and to the right. Now their dividend, they increase their dividend every quarter, I believe, and they're usually really small increases, and then they do one like decent 2 to 3% increase after that. But they've been increasing their dividend at 3.8% over the last 10 years, which should be beating inflation in the long run. I know it's crazy right now, but ideally they want inflation to be between like 2 and 2.5%. So this is technically still giving you a raise that should be beating inflation. Let's see here. They've been increasing their dividend for 30 years. 30 years. Realty Income. This is a company you don't see dip below 60 all that often. If you take a look here, it dipped below 60 whenever the 2020 like chaos from COVID had occurred, and it touched in there a time or two more. It dipped back in October when pretty much the sky was falling, the market was crashing, and we all thought the end of the world was coming. And currently, right now, it is below 60, currently sitting at 58.62. I don't know why I said 0.62. It's $58.62. But yeah, they are down. They're at a recent high as of a year ago. Well, it's right at $75. So you're getting Realty Income. It was a recent high of 75. You're getting it at 58.62 right now. I like this play a lot. I want this in my portfolio, especially at this price. I like it. Next up, another REIT that I would love to have in my portfolio. Vici. I love me some Vici, especially in the 30s. $30.89 current price. And before you go out and invest in REITs, make sure to do your research in them. They are taxed differently. There's a couple different things that comes with REITs, real estate investment trusts, than a normal stock holding. But yeah, just always do your research of anything before just throwing money at it. But Vici got just a free cash flow yield of 6.52%, dividend yield of 5.05%. And as of with Realty Income, you don't pay attention to the payout ratio. They pay it from funds from operation, FFO. They don't pay it from like the earnings. Revenue has been increasing at a dumb rate of dumb. Just this is a newer company, but yeah, it's been around for a couple years now. But yeah, 66.8% over the last 5 years. Cash flow, free cash flow, it's going to be the same story. Just dumb, so dumb. Dividends been increasing at a rate of around 8.2% over the last 5 years. If you can give me a company has a dividend yield of 5%, you're going to be giving me anywhere from 7 to 8% raises on my dividend. That's pretty good. That's pretty good compounding right there. Pretty good compounding. Can't complain. It's a newer company. It's been increasing its dividend by 4 years, but yeah, Vici Properties. I like them. They're casino REIT mainly. They're in Las Vegas. Realty Income's just, they got their hand dabbling in a little bit of everything. You can look up their portfolio. They're very diversified. But yeah, that is everything I've got for you. And that's 5 dividend stocks you can buy and hold forever. 3 stocks, 2 REITs. Hope you enjoyed that. Make sure you hit that like and subscribe button for more. And until next time, see yous.